Hey guys, Phillips Trading here, and I'd like to show you something really cool actually, which is about top picking exercises. And I want to explore the psychology behind top picking exercises and a simple way you can use to avoid shorting bull markets. Okay, so there is one particular type of bull market move that you absolutely don't want to get in the way of shorting. And what this is called is a low volatility melt up. So the end phase of bull market moves happens in one of two ways. You either get a blow off top, like in 1999, or you get volatility dropping and dropping and dropping and dropping until it becomes unsustainable, and then it sort of falls off the plate like 2008. So we've got these two situations which happen fractally on every time frame. So one is a 2001 blow off top, and the other is a 2007 low volatility top transitioning into a trading range, breaking down over a longer period of time. So there's something inside all of us which is quite stupid, and that something always wants to be right. And you can, it happens to me, it happens to you, it happens to all of us. You jump on Facebook and get into arguments with random people because you just like being right. And that desire to be right really affects us all badly, and it fucks with our trading. So what I've got up here is ATR. I'm using it as an approximate for volatility. It's not really volatility, it's candle size, but whatever. It's close enough. When you see the market going up like this, with volatility going down like this, this is your danger, danger, danger warning, Will Robinson. You never short these markets, because these type of moves, they paint these incredibly good-looking short sell setups. We're looking at the E-mini weekly contract here, so we're looking at a longer-term view of the U.S. stock indexes leading up to from the election leading up to the present day. And what we can see is that this first move from here to here, quite strong. But objectively, the second move from here to here, not as long. Okay, so what we're seeing as we go up is each additional thrust is getting less and less. So we're seeing the average candle size is getting smaller and smaller. And if we look individually at around this point, we should have been able to recognize, and if you look at what the market would have looked like about here, this is a pretty good looking topping pattern. You could reasonably assume that the bears had a chance here, but in this low volatility, in this decreasing volatility as opposed to low volatility, in this decreasing volatility, these are nearly always stopped out. So you get this like bam, punched in the face. And so what happens here is that the bears who got in here are forced to cover. They fuel the next rise. So this type of market is not driven by genuine buying. It's driven by a continuous, slow motion, long running short squeeze where the shorts are always saying it's about to turn, it's gone too fast, it's so overbought, and then they continually get shat on, and continually again and again and again. So the easiest way to avoid this is to stop playing the game. Now, when do you start playing the game again? It's a really interesting question. We start playing the game again when we have historically low volatility. When we have unsustainable low volatility, you can see here is about the lowest that it's ever been. So when volatility gets down to a historical low, you know that it's probably looking a bit unsustainable. Now, at this point here, we start to get interested in the short side again. Now, let's look at the E-mini on a weekly basis. We have a nice little inside bar. We have a potential retest of the highs. We have very small candles. Historically speaking, you can see the candles over here are just way bigger. You don't need an indicator. You can just say, well, the candles are bigger. And the candles are really small here. So one of the things we know about volatility is that volatility is much easier to predict than market direction. So volatility actually is predictable. Market direction, ugh. Some people say it is, not for me, but whatever. So what I want to do is I want to look at this on a daily basis now. And say on a daily basis, the time has come for us to start getting interested in the short side again. So what we have here is, as discussed, we have a long running trading range. We have 1, 2, 3. We have over 20 bars of trading range action here. We have a bad fail by the bulls here. It has not even tested the top of the trading range. It's gone up. The bulls are dramatically weaker than they should be. Here we have what we call a stick save bar. So the bulls know that a close below the bottom of this trading range completely invalidates the bullish thesis, and all the bulls will have to get short. So you would expect some buying pressure at the bottom of the trading range, and that's exactly what we've got. So even though this bar here looks like a strong bullish candle, it's in context. When you read it in context, it's actually not strong bullish candle. So we have a very clear line in the sand now. A drop below this line completely invalidates the bullish thesis, and we should see it drop away. Okay. One other market I'd like to discuss, which is super interesting today, which is the Euro-US dollar. Let's see what we've got here. All right. So I want to show you a longer term view of the Euro-US dollar, and let's zoom it right out. Okay. So what we have a giant big move. It was a breakdown of a long running trading range. We have a trading range that's gone on for so long. This trading range has been going on since 2015. The breakout, the longer the trading range goes, when it breaks out, the more decisive the move is. So if you look at down here, for a brief period in time, it looked like the Euro bears were going to get their wish and we're going to get a breakout, but you have this same phenomenon of the stick save at the bottom of the trading range. Once it's been made clear that the bears can't push it down any further, it's natural for the bulls to push it up to the top of the trading range. Now, if we look at it on a daily basis, this looks like a very strong bull trend, right? Like it looks like if we've got a gap and go, we've got strong up moves, we've got very few overlapping bars in the up moves, and we've got lots of overlapping bars in the down moves. We've got everything looks perfect on the bull side, except when we're in a trading range, you can always expect what's called a vacuuming to the top of the trading range. So inside of trading ranges, the directional moves look quite strong. They look strong enough to trick naive traders into thinking that they're actually breakouts when they're not really breakouts yet. So we have a trading range which is, sitting somewhere around here. The exact where you place your trading range, is it here, is it here? That doesn't matter much, because it's not about the actual squiggle that you draw on the chart. It's about the recency bias of participants and what is where did they get in before. So we've seen selling pressure come in around here, which is exactly where we are. We're somewhere in the zone that we should see selling pressure. If we don't see selling pressure and we see a close above here, Euro bulls are off and running. the dollar is completely destroyed. But we have a very brief window of opportunity for the dollar bears to turn it around. And if we look at this sequence of moves, we've seen higher high and higher high and lower low the whole way. So we've got a higher high coming back to a lower low. Coming back to a higher high. Coming back to a lower low. Coming back to a higher high. Coming back to a lower low. Now, what should happen if the pattern continues, if this bull move continues in the simplest form, this needs to go and make a higher high. But we zoom right in, and let's look at the micro view of these last couple of candles. This should be shooting to new highs, and it very well may. But right now it hasn't. The high of this bar is below this old high here. That's stinky. So what this represents is this is a place where the bears can wrest control again. So the way we're going to trade this today is by putting a sell stop here. If it gets executed, our stop loss will be here. And we're going to look for some mean reversion. Now, there are three possible scenarios at any given time. We've got a bullish trend, we've got a bearish trend, or we've got a trading range. If we've got a trading range, we might reasonably expect that trading range to look something like that, right? So we have to craft a risk-reward trade that gives us a positive trader's equation on the target, if it's a trading range. If it's a trend, we can try and hold for a big winner and trail a stop and do all that stuff. And if it's a bullish trend, this low should never be hit if it's a bullish trend. So by crafting the setup this way, we try and avoid the pain. If it's not a bullish trend, we probably won't be in. If it's a bullish trend and it breaks out to new heights, we probably won't be in the trade at all. If it's a bearish trend, that's going to happen about 30% of the time. You need to craft a win reward. You need to craft a target exit profit trailing mechanism that gives you a positive trader's equation on that, which is quite difficult. Now, the low-hanging fruit, the easiest thing you can do in this situation is we know that this particular setup is going to have a win rate of around 62% for a 1R win. 62% chance of a 1R win versus a 1R loss is a positive trader's equation. We can take that every day. So this is the very simple way to trade this setup. What we're going to do is measure the distance from the high here, which is 1445.5, so call it 1446, down to 1379, so it's 46, 66, 67, we're risking 67 pips. We want to put a 67 pip target on it. If you want it to be a little bit more ambitious, you can put 1.2R on it. So, so personally, I'll be going for a 1R target on this trade today, and I'll be trading it on the 6E CME Euro futures. Okay, thanks very much. Have a great day. Bye.